things like gold and silver now just broke $70 an ounce in the spot market here in the US. And it hasn't looked back. It broke 50, it broke 60, and now it broke 70 without any real resistance. So the silver story alone is complex enough and interesting enough for us to do a whole show on it. But we're seeing it play out in real time right now. That is the dollar debasement trade. There are new solid state batteries coming along for electric cars that are much better. So we're told. They charge in no time at all. They go 600 miles, and they use silver, and they use quite a bit of silver. So if they actually turn out to work, and Samsung, for instance, has scheduled the beginning of mass production for 2027, so it's not that far out. But if they become a thing, if that's the new way to power an electric car, then there's no silver left for anybody else. That each electric car using those new solid state batteries will need a kilo of silver. As people lose faith in the currency, then they start moving their money into real assets that governments can't inflate away. That spikes the price of those real assets, which is inflation. That's the dollar falling in value versus gold and silver and oil, on and on and on. And then you get an inflationary crisis. It's baffling because there are so many signs of a recession, big layoffs over here and people are over indebted over here. The student loan debt is kind of overwhelming for the people who have it. Credit cards are starting to default at an accelerating rate. Car loans are starting to default at an accelerating rate. Mortgage debt is at an all-time record high in the U.S. So those are things that point to a slowdown as consumers aren't able to consume because they have no money left. But at the same time, you've got the federal government running $2 trillion plus deficits every year. And excuse me, a little cold today, so my voice is going to be scratchy. But that the money that the government, the deficit is borrowed money. So the government borrows the money and then spends it, which is very stimulative. So the result is a lot of statistics coming out that are contradictory. Some look bad, some look good. And, it doesn't seem like we're currently dropping into a recession, which for the past year or so, it seemed like was imminent. But I don't know. These cross currents are going to continue until one side or the other becomes preponderant and wins out.
John Rubino analyzes the contradictory U.S. economic signals. Massive government deficits are propping up growth, while consumer debt defaults, layoffs, and unemployment point toward imminent recession. The stock market mirrors the 1999 dot-com bubble, overvalued and vulnerable to a crash that could trigger economic collapse. With government debt spiraling out of control and the Federal Reserve out of ammunition to fight inflation, we face a crackup boom where currencies plummet against real assets.
Every debt chart out there for the major governments of the world are parabolic now. They're going straight up. And then the interest cost on that debt is so onerous that it makes it impossible to use tighter money to keep inflation under control. That shifts the pressure over to the currencies of the world. For instance, if you've got 0% interest rates and you're running massive deficits and your debt is spiraling out of control, then who wants to own that currency or bonds that are based on that currency? And so you shift from a general financial crisis to a currency-specific crisis where the value of the dollar and the euro and the yen and maybe the yuan all start to fall in a disorderly way. And we find out that we can't raise interest rates to fix that. And then, therefore, the Fed is out of ammunition. And so the whole world realizes all at once that we have no tools left to manage monetary policy and control inflation. So we do not want to own these currencies. So the result of that critical mass of people coming to the conclusion that the currency isn't worth holding anymore is, in the Austrian School of Economics, it's called the crackup boom. Now, the U.S. stock market is basically supported by 5 or 6 or 7 big, powerful technology companies. And the global economy, to an extent, is supported by the US economy. So you're looking at something like what we had back during the dot-com bubble. And I've mostly been saying silver, but I think there's also kind of a big short scenario out there where if you short the NASDAQ, for instance, using long-term put options, that might not be the highest probability bet, but it's up there. That might be the kind of thing that generates the life-changing money for somebody with the courage of their convictions in the year ahead. Let me see. Well, the big short thing we've talked about. I think that's a story for 2026, where if you can tolerate the risk of being short the stock market, this might be a fun time to learn how to do that. Round tripped. And a round trip to say 30-ish is completely possible if we have that recession and equities bear market, and they throw all the babies out with the bathwater, and gold and silver are among the babies, and they tank. That's a completely believable scenario. And you really don't want to be. I mean, if you have to ride it all the way down and then ride it all the way back up, you still end up being fine, but it's emotionally exhausting. It's horrifying to be round tripped in a big position.
Silver emerges as the perfect storm. Central banks relentlessly accumulate gold, solar panel demand already consumes massive silver, and Samsung's solid-state batteries, using 1 kilogram silver per car, threaten to consume all annual production by 2027. This industrial demand, combined with monetary debasement, could send silver into triple digits. Investors should shift from financial assets to commodities, consider hedging with NASDAQ puts, and prepare to convert silver gains into depressed real estate during the coming crash.
So that's the tricky thing now. How do you structure your money and your investments so that you're reasonably protected from a V-bottom crash, which we could easily see, but you're still exposed to something like silver for the long haul? And there's no one right answer. You take a little bit off the table so you have some cash. So in case there's that V-bottom crash sometime in the future, you're able to console yourself that, yeah, your existing silver went down, but now you can buy a bunch more and have another chance at a 10-bagger run going forward. And yeah, like Warren Buffett is doing now. He thinks U.S. stocks are bullish in the long term, that the U.S. economy is going to be great. The stock market will be a very successful place to have your money, but he's raising more cash than he's ever raised in his life because he doesn't see bargains out there anymore. And so he expects to hold that cash until the stocks he likes, the companies he likes, till their stocks drop to a reasonable level. So, yeah, that's the intellectual challenge of a bull market. And, a lot of people, a lot of stackers are going to be living in their dream house 5 years from now because home prices in the US will go down in dollar terms, but they'll crater in silver terms. So you look at a house that is now $1 million, $1 million US is going to be the equivalent of $200,000 or $300,000 when you price it in silver. But still, you've got valuations that in the aggregate are just crazy, and fundamentally they should not continue. So that might be the thing that causes the recession. If you have just a normal equities bear market from this level, where stocks drop by 20 or 30%, that would be enough to throw the US into recession. And there we are. Then all these other things that have been kind of looming in the background will come forward. There'll be front burner issues, and we'll have this debt crisis and shrinking growth and all the things you normally get during a recession. That's one catalyst. There's a bunch of other catalysts. I think that something will blow up on us in the not too distant future, but there's no way to know what it will be. And frequently, it's a surprise to even the people that are catalyst watching. It's something that comes out of nowhere, and hopefully, it's not geopolitical in the sense of us getting into a war with somebody where it's serious. Like the Ukraine thing was just terrifying, because the U.S. was blundering into a shooting war with a nuclear power, and if American soldiers and Russian soldiers start killing each other, that's the kind of geopolitical event that will give you an equities bear market, which in turn will give you a recession. So X number of tons of gold. And you're not going to disappoint him. So the price bouncing around isn't going to affect your buying because you've got a target of X, meeting that target rate in a given time frame. So you're buying steadily at a rate that puts you where you need to be so you don't get murdered by your government. And that's what a lot of central banks are thinking about right now. They're not thinking, oh, let me get a good deal on this by putting a low ball bid in. They're thinking, okay, I've been ordered to accumulate this many tons, and I'm just going to do it. I'm just going to steadily do it, and I'm going to meet that target. And so that is a big reason why gold has been going up steadily. Like we haven't had a big crash in the gold price, which, it blew through to $2,000 an ounce US. Then it blew through $3,000 an ounce, consolidated a little bit there, blew through $4,000 an ounce, consolidated just a little bit, but not noticeably, really. And now we're halfway to $5,000 an ounce. And the reason for that is that these big whales out there that have printing presses that can generate as much new money as they need to, buying silver to make silver go up in price. So, I think that it's completely possible that silver has one of those runs that you just talk about for a century in the next few years. And monetary, it could happen just because of the currencies of the world having their waterfall declines, or it could happen because industrial technology is changing in a way that requires more silver, or it could happen from a combination of those two things. And if it's a combination of those two things, then I don't know what the upper limit is for silver. I think we see some triple digits for sure, but how far up into the triple digits is anybody's guess. And the only conclusion that you can come to is that you need to own some silver. That this is even possible, that we can even talk about this, means a share of your nest egg needs to be in physical silver and possibly silver mining stocks. So that's a whole investment thesis right there, how you use precious metals in all their forms to protect yourself from what's coming. And you can always get out. If you've got like Charles Schwab has a treasury bill ETF that you can sell like a stock. So you can get out instantly if you need to. But in the meantime, it's a way of parking cash, and you can do something like that. And within the commodities complex, which I think is still the best place to be right now, even though they've had some nice runs, there are still some undervalued sections of that complex, like oil, for instance, has gone down while everything else is going up. And the dynamic in the oil industry is pretty bearish because we're producing an awful lot of oil and natural gas around the world. And they're cyclical, so if we have a recession, people drive less, the price of oil goes down, that hurts the earnings of the oil companies. But the biggest high quality oil companies will still be okay. Exxon has raised its dividend for something like 50 years, straight through all the recessions and near depressions and everything that we've had. In 1999, there was a saying that, the global economy depends on the U.S. economy, and the U.S. economy depends on .com stocks, and 90% of those .com stocks don't make any money. That was something you heard a lot back then, and it turned out to be right. The .com bubble had to burst, and it had to metastasize into a recession for the U.S. Just because that's the normal way the cycle goes with credit bubbles. Well, we're back there again. This is extremely similar to the .com bubble, except that some of these big tech companies are actually making money as opposed to just generating eyeballs.